So, good evening, everyone, and a very warm welcome to episode number 6 of the Trading Heads webinar series. Tonight, we invite you to challenge one of the most entrancing beliefs in portfolio management diversification. That is diversification. It is true. Is it truly your safety net or just a well-packaged performance drag? Join us Joining us is none other than Mr. Perry Kaufman, a pioneer in quantitative trading and president of Kaufman Signals. From designing control systems for the Gemini space missions to crafting rule-based strategies that shape modern-day trading, Perry's journey is a fusion of science, markets, and mastery. In conversation, we will explore today why diversification, when misapplied, becomes delusion, how focused selection creates alpha where broad spread does not, and the tools and mindset that separate top performing portfolios from the rest. Get ready to unlearn the old and embrace the systematic approach. Let's begin. Hello, Paddy.
Well, hello. Thank you for having me here, and good evening to everybody.
It's a pleasure to have you, Paddy. I think we first met in 2020, right, where you gave one presentation on your efficiency ratio, I remember, right, and how to identify the markets which are like efficient, like which are trending basically, right? So let's begin today's presentation.
Okay, you want me to start now?
Yeah, you basically first I would like to know a little bit about yourself, how you started trading and how this shift happened from a rocket scientist to a trading journey, how your trading journey generally started.
Uh, it's a, that's a long question, actually. So, I mean, I did start in aerospace, and when we had free time, we used to use uh, exponential smoothing that we used to use uh, for trajectories in missiles to apply to the stock market. It was, the very first approach we had to using essentially a moving average. And that worked really well. The market was very, very different in the 1970s than it is now. It was very smooth. You could use a 10-day moving average and make a lot of money. So, which is why people like Donchen created those 5 and 20-day moving averages and 10-day moving averages, and they work really well. But, as time moved along, the market got noisier, more people participated. And although you would think it's counterintuitive, the more people that came into the market, the noisier it got. We used to think more people would make it smoother, but it doesn't. They come in for all different reasons and they move the market around. And so it turns out that what used to be a 10-day moving average or a 20-day moving average is now an 80-day or a 100-day moving average in order to make money. And with it comes a lot of risk. So the market changes. And I don't know if I've answered your question about my evolution, but
Yeah,
that's really what's
you have,
happened to the market.
right.
Anyway, so from aerospace, I went into forming my own computer company. And I had an early client that wanted a strategy for London options. And that got me started in looking at futures markets. And, once you start looking at the markets, it's addictive. You just want to do better. You want to make money. You want to understand it. It's the ultimate in free enterprise. And once you know, I don't know too many people that start trading that stop trading. Well, unless they lose their money. But otherwise, it's just a wonderful venue to pit your intellectual, stamina against the market. So anyway, so there I just developed, strategies, and I moved from one company to another and form different funds and work my way up to where I am.
Great.
So now, are we ready to do about diversification?
Yeah, definitely. We can start.
So
I'll switch off my video. You can start, Perry.
oh, really? I'm sorry.
Yeah.
I just see. Can you see my presentation?
Yeah, we can see your presentation.
Okay. Well, in that case, everybody, that's me. I look more or less the same as I do now, so you should be able to recognize me. Let me go over here. All right. And this is the presentation. We're going to talk about diversification. And the beginning of it will be somewhat routine, everything you know about it. And I'm going to work into what I do with diversification. First, as a little disclaimer, which is probably of no interest to you, the real important part of this disclaimer is that you shouldn't believe everything someone says. Even in my presentation, I read a lot of books and read magazines, and I see systems that are being presented. And when I check them out, and I usually can program most of what I read, I check them out and I find the examples that people use are very limited. And if you want to use their strategies, they don't turn out to be very robust. So if I have a strategy that someone's proposing that trades the S&P nicely, I want to look to see if it trades the NASDAQ, because they are like 90, 95% correlated. If it doesn't work on NASDAQ, it's a problem. And if it does work on NASDAQ, then I want to look to see if it works on the DAX. DAX is more volatile, but it's still quite similar. And if it's not the DAX, I want to look at the Hang Seng. And if it doesn't work on those, I want to know why. So part of this disclaimer is really trying to convince you to verify everything you hear. And that's what this little reminder is here. You need to question everything, especially if you're looking at strategies that are presented by somebody else. I'm not really presenting a strategy, but I'm going to present a concept here. And you won't, as I say here, you won't own this strategy. You won't believe it unless you test it out yourself. Otherwise, when something goes wrong, you'll discard it. You have to actually understand what the risks and the rewards are to keep trading something. So here are some gentle reminders. Oh, and when we're all done with this, I'm going to send a PDF of this presentation, so you don't need to write anything down, or at least select what you're going to write down. At the end, there'll also be an email that you can ask questions directly to me, and I answer them all. But please make them short. Don't give me your trading history. Don't send me your strategies and ask me to debug them. All right? Short questions that I can answer, I'm very pleased to respond to. So these are the general points. If you see, I'm sure you've seen strategies that that just look too good to be true, and they generally are too good to be true. Those are the ones you really have to test. Also, as I said, you need to verify everything that you see. And if you don't, as I say, if you don't verify it, you don't own it. And it's important to own the strategy you're going to trade. And then you start very, very small. One of the problems with new traders are they don't understand a loss. And as soon as they see a trade that goes wrong, they think that the whole system is horrible. I remember our daughter was a runner on the floor of the CME when they had pits and things like that. And one day a trader came to her and said, "Look, I'm doing really well. Would you like to participate in one of these trades?" And she said this was her big opportunity. She had $100 or $200, and he allowed her to participate with that. And the first day, he made $300 for her. It was wonderful. It was like doubling her money. And so he asked her if she wanted to continue, and she said yes. And the next day, he made $500 for her. I mean, this was what everybody wants. And so she continued, and the next day, he lost $1,000. She was so sick, she couldn't go to work for a week. And so it's the losses that you need to understand. Until you become experienced trading, the losses are the biggest issue. And you need to become immune to them in order to keep trading. Anyway, that's just a little side story. And the reason why you want to start small, because when you have a loss, it's still okay, and you'll learn what they are. So, as I said, the first part's pretty standard here. We're going to talk about diversification, not putting all your eggs in one basket, needing to invest in stocks or futures that are fundamentally different. Markets that are different in volatility is not really diversification. So you have to be careful, because you can reduce your exposure or increase your exposure in a market with different volatility and wind up much with the same profile as another stock. The most important way to diversify is with different strategies. And we'll talk about that because the easiest thing to do is have one trend following system and one mean reversion system. That's the simplest way to diversify strategies. And we'll talk about a few other possibilities later. Changing the time period, using a moving average, that's 20 days, and a moving average, that's 100 days, offers some diversification. What you have to keep in mind is if all the strategies use the trend, if they're all trend following, then they're all making money from the same move. Even if it's a 20-day moving, it's making money from a shorter part of that move versus a 100-day, but they're all making money at the same time in the same move. So you really need to focus on the essence of the strategy and be careful not to have too many strategies that are trend following. So I think that's about what I've just said here. The way you determine whether two strategies are the same is not by looking at the correlation in price, but looking at the results of the system, correlation of the system performance. It's the only way to really measure the results. Otherwise, the strategy itself can look similar, but if you're using mean reversion and trend, the results are going to be very different. So you need to correlate the performance rather than the prices. Oh, and the last thing here, remember when the markets are in crisis, which means something exceptional has happened, like the 2008 financial crisis. All the markets move the same. Doesn't matter whether they're stocks or futures, uh, or even cash markets or art or whatever. What happens is you start to lose money in one market. And to do that, you need to replace the losses with markets from somewhere else. So you start to liquidate other markets to move money around. And that includes physical markets as well. So everything starts to move in the same direction, even if they have no relationship to one another. You're taking profits from one market and moving it to the next. It can be ugly. And I think perhaps if you go back in history and look at these things, you'll see the problem. So one of the problems we're going to have in developing a strategy is to try to avoid those risks. And later on, I'll show you how I avoid it for the most part. And just this is a little example of the fact that you see on the right here, one market looks as though it's more or less going down, and some markets are more or less going up on the bottom. But I promise you this correlation is probably 95% the same, so that you don't really get diversification by trading the NASDAQ versus the semiconductor ETF. But you probably know that. And these look pretty similar. But in another case, these don't look very similar when you look at them at a different perspective. And yet the difference between these two markets is the correlation is 0.88, which means that when you try trading them, you're going to find that you're really not getting much correlation. But anyway, you have to do this yourself. You have to test both the correlation of the prices and the correlation of your system. Now, here's something that you probably will agree with me. This just shows the maximum diversification you can get trading more markets. So obviously, if you trade one market, you have no diversification. That's on the left. You're at 100%. When you trade two markets, you can drop that to 50% if the diversification is perfect. And if you continue that out, you'll see that as you get further out, obviously your benefit from diversification becomes smaller and smaller. Well, my conclusion is anything more than 10 is really wasteful. That in my personal portfolios, I rarely trade more than 10 markets, whether they're futures or stocks, because I don't think that the benefit from diversification is enough. And I do it simply based on this kind of chart that I'm not going to get diversification as good as this chart. And so the diversification will be smaller. I can't actually understand why some funds will have 20 or 30 different strategies. How is that possible that they can get that much diversification? Are they all making the same returns? It seems to me as you add markets, you're going to add strategies that have less payout than your original ones. You're going to start with the best strategies you have, has the best payout for the least risk. And as you add more and more and more, you're going to get lower returns and not much lower risk. So I just don't know how it works, but But personally, I'm not interested in a fund that has 50 strategies. I just have a difficult time understanding why that's worth the effort. So, and when things don't go right, do you know which strategy is going to be bad and how long it's going to last? So anyway, just so you know, I limit my diversification to 10 stocks or 10 futures markets. And what do we have if you really get these, if you really trade a large number of stocks, if you're very careful about trading stocks that are in different industrial groups or different sectors, and you maximize your diversification, what do you get? As far as I'm concerned, you get the results of the S&P or NASDAQ or some ETF. Why do I want to do that? If I wanted to do that, I might as well trade the S&P, or might as well trade the ETF. And am I going to perform, if I'm trying to make this a business or even personal, do I want to perform the same as the S&P? I mean, who cares? I want to beat the S&P. I want to beat the S&P in terms of returns. I want to beat the S&P in terms of risk. And that's not actually so hard. The S&P makes 6 or 8% over the long term and has a risk ratio of somewhere between 0.3 and 0.35. So it has 3 times as much risk as return. Now, if you can't beat that, you don't deserve to be in the market. So that's your goal. You need to get a better return than the S&P for the same risk, or the same return for lower risk, which is the same as this this chart on the right, which is the efficient frontier. You know, you see those dots show you the points on the efficient frontier where you can have a better risk for a lower return or whatever it is. So that's your goal, is to come up with a system that beats the S&P in one way or the other, and that will attract customers, and it will also attract you for trading it yourself. Now, Soviet has sent me an email in which he agrees with me. I love people that agree with me. And he agrees that, and I think he phrased it very nicely, that diversification is a classic safety net, but with too many nets, you dilute the catch. And that's really what I'm talking about. You want to use your best systems all the time. And you have to figure out how to make that better than the S&P or whatever your benchmark is. And if you fall back on trading the S&P, it means you don't have enough confidence in what you're doing. That's not a good recommendation. Now, how do you go about doing that? The way I do it is to select markets for both for the stocks and for futures markets that will outperform the general market. Okay, and of course, now I'm going to talk about how do you do that, and of course, it's very important. The markets could be less volatile with the same returns, and they could be more volatile, but have much higher returns, or an uncorrelated strategy, as I said, thinking about mean reversion and trending. And of course, how do you do that is the biggest game. How do you select markets that are going to outperform the market by whatever basis you think is important. So the first thing you do is you need to create a strategy. Surprise. So, and the strategy can be as simple as trend following. And here are some examples of various things that you could use to create a strategy. I don't care what they are. All of these things work if you do them correctly. And in most cases, all of these things are also good for diversification. You notice in none of them is the trend the major component. So with intraday patterns, I use, patterns and not trends. So I find something that is generally mean reverting. Intraday trading tends to be best with mean reversion. You can do pairs trading, which is an arbitrage. You can do FX carry if you're familiar with that, which is trading one currency against another based on interest rates. Anyway, these are items that you could pick from in order to create your trading system. But the easiest one is going to be trend following. And I'm going to focus on that at the moment. So as I said, you can beat the index by picking the right markets. I know that, as I said, I know that seems obvious, but these are the problems. How do you decide which those markets are? Are they the markets that have the highest return? Are they the markets that have the highest Sharpe ratio, highest return for the lowest risk? How far back do you look? Do you want to go back 20 years? Do you want to go back 1 year? I know people that will go back only 6 months and use whatever seems to work in the last 6 months. The time period you pick is going to be very important. I'm told that if you pick a short time period, that means your system will decay quickly. So you're going to find very good results in the short term, but they won't last long. And I guess you can compensate by retesting that regularly. Or you can use a longer term, which is what I use. And the system, when you use a longer amount of data, the system has already decayed. So what you have are results that are more predictable, although with higher risk and probably lower returns. These are all choices you have to make. And they're not easy choices. But, every one of you will have your own opinion as to what works best for you. And if you go back a long time, as I do, you then need to figure out ways to control the risk, because using parameters that work over a long term also tend to hold positions during periods where the market takes substantial sell-offs. And so you had to figure out how to fix that. And I'll give you some clues about that. But in my opinion, most clients want the systems that have the highest returns. They're willing to accept a certain amount of risk because they really, really want higher returns. So offering a system that has lower returns than the S&P, but much lower risk, is not going to attract too many people. It will attract some that are looking for conservative investments, but not as many as the ones with higher risk, higher returns. Sorry about that. I think I need a drink. Just a little side note. Can you have low volatility and higher returns? And I think you can, but it's a very limited periods. I think between 2010 and 2018, we had an incredible bull market in stocks. And that offered you tremendous returns at lower volatility. And then in the bond market, we had years of interest rates coming down with low volatility. That was nice too. Unfortunately, we don't have that anymore. But these things will come back. I just wouldn't count on them right now. Okay, this is the process for finding the best stocks. This is the way I do it. I'm sure each one of you will look at this and do it your own way. That's why I have no concerns about telling you. I've never seen a good developer that has taken somebody else's idea and developed it exactly that way. They all put their own imprint on their strategy. So what I do is I create a strategy, and it could be as simple as trend following. And then I run all of the markets, futures or stocks, through that strategy every day. And I then look at the returns for each one of them by sorting them. Now, the big issue is, how far back do you look? If you look 20 years, you're going to have a portfolio that never changes. And if you look back only 1 month, you're going to get stocks that jump in and out. So somehow along the line, you have to figure out how far back you look in the performance of your system for each one of these futures or stocks market, so that if it was a market that was not trending at one point and then starts to trend, your system needs to be able to incorporate that stock into your new portfolio. And it's a tricky issue, is how far back do you have to look? I would say start 6 months ago. All right, so that a market that started trending will at least have some time to show you that it's still trending. And you can adjust in and out from that, 9 months, 3 months, judging like that. So the long term, you may consider eliminating some stocks that have done horribly over 20 years, just because you have no confidence in them. But you do want to look at more recent performance in your system to show which stocks and futures markets are now working well with your system. Okay? And that'll be okay, because what we're going to do is every day we're going to run our system through all of these stocks. And computers are fast enough. I run my trend following through 400 or 500 stocks. It takes 1 minute, not hard. And then I sort them all. That takes nothing at all. And then I have a list of the stocks that are doing the best over the last 3 or 6 or 9 months, whatever I'm looking at. And then I choose the top 10. I said I like 10. So it allows me to outperform the market. And the reason it works is persistence. Markets that are trending tend to persist. I mean, look back at Amazon and Tesla and NVIDIA and these stocks that did incredibly well. If you use this approach, you will get all of them. You'll also get rid of them when they start to go the wrong way. And the nice thing about sorting the performance over, say, 6 months is that you don't need to wait until this long-term trend turns down, give back a lot of money on the trend before you get out. Because if you're sorting you're picking the last 10 performance, good performance, that NVIDIA can fall down out of the top 10 pretty quickly when other stocks move up. And so you could be getting rid of NVIDIA even while it's making money if it falls down out of the top 10 performers. And that's my biggest risk control, is not waiting for the trend to turn, but getting rid of the performance when getting rid of the stock when it's no longer performing in the top 10. I don't know if that's what I said in this slide, but there you are. So I'm picking the top 10. And I think I've just said this in many different ways. Too long and your selection really changes, too short and it's unstable. So you need to find the period. Now, what do I use for that? I said that it was the results, but I didn't actually mention it as clearly. One of the things I found, I've tested all sorts of criteria for deciding when the performance is good. I've tested profits, I've tested the Sharpe ratio, return divided by risk. I've tested a lot of different criteria, and it turns out the only one that actually works is profits. It's not profits divided by risk. The market doesn't like to be hemmed in by too many criteria. As soon as you start asking for more, nothing works. So you can try it yourself, and I suggest you do try deciding whether profits are better than profits divided by risk. Maybe you'll find something that I missed. But when I do this, I look at profits only. And that, of course, allows me to outperform the market. When you start looking at profits divided by risk, you may get something that has minimum profits and very, very low risk. And that doesn't really qualify. So now you have to say, okay, I need at least a minimum amount of return. And now you're getting into more and more qualifications. And I say the more you do that, the less the market is going to respond to that. So the simplest possible result is going to be the best. So this is just a little picture of sorting. Now, let me mention that futures are a bit different. And I trade futures. I grew up trading futures. One of the problems with futures is if you select the markets that are doing the best, at some point they could all be interest rates, or they could be index markets. Because there is a correlation between the interest rates, US interest rates, even US versus European interest rates, not much these days. And so if you're dividing up sectors, you might want to separate the US from the European interest rates because they are really moving differently these days. But in any event, I check my sectors. If all of my markets being chosen are from one sector, like interest rates in the futures markets, I reduce my exposure by 50%. It's the only way I have of reducing my risk. If I can choose two sectors, even though there are correlations between these sectors, interest rates and FX markets tend to be somewhat correlated. But if I have two sectors, I reduce my exposure by 25%. And if I have three sectors, I'm fully exposed. So that's my only criteria for reducing risk in futures. In stocks, I have some other exposures. For example, if my portfolio exceeds 32%, I tend to reduce my exposure in my portfolio. So I look at the 20-day annualized volatility of my portfolio volatility. And when that gets to 32%, it means there's something going on in the whole market that is causing volatility, and I reduce my exposure. I put it back on when the volatility falls below 32%. You'll have to test that yourself. Every strategy has its own points. You might also consider not reducing it if you're making money. If it's above 32%, but you're making money, you might consider waiting until you start to lose money before you get out of or start to reduce your exposure. And on the other hand, when you fall below 32%, you might wait till the underlying system starts to make money before you add back. So those are just two thoughts about how you can reduce the risk in stocks and futures markets. So let's just summarize a few of these things. First, you need to find a good strategy. I think trend following is a good place to start. You can add mean reversion, but mean reversion strategies are more difficult. And you may find the S&P works for both. In the very short term, S&P is mean reverting. In the long term, it's trend following. So you could use the S&P. It turns out that short trades in the S&P using fast-moving averages always lose money. There's a way to start using mean reversion. When you create your portfolio, you want every trade to have equal risk. And I'm sure there are presentations about how to do that. I use volatility parity. You can find that somewhere. And then use the markets that are working the best on your strategy. Use only profits as your criteria. I pick only the 10 best stocks or at least 3 futures sectors. I switch daily when the performance changes and the stocks move up into the top 10 or futures markets change. And I mentioned that I exit stocks when the volatility is 32%. Simple diversification. If you really want strategy diversification, which is the best diversification, trend and mean reversion works. Other choices: yield curve, merger arb, FX carry. Think about what the brokerage firms have in the way of the departments. All of these tend to be departments within a brokerage firm's trading area. And they define very well diversified strategies. So that's one way to think about what strategies you might need. Okay, so here are a couple of more general rules. My favorite is loose pants fit everyone. When you're doing strategies, I pick parameters that have risk but work on more markets. Very important. I said at the beginning, if you have a system that works on the S&P, it better work on NASDAQ. It should work on the DAX, and it could work on the Hang Seng. Now, it may not work brilliantly on the Hang Seng, but it shouldn't lose money. All right? Or on Nifty. In other words, a strategy that works on one index markets should somehow work on other index markets, or you should know why. The fewer rules, the better. And fewer rules are good because if something goes wrong in your strategy, it's nice to be able to identify where it went wrong. If you use a strategy with a lot of rules and things go wrong, you may not know which rules are the problem. And so I choose to use fewer rules, have greater risk, and work on how to reduce that risk with a simpler system. Don't fiddle with the results. You may make them look good, but they won't really work. Making a little change here and there is not a really good way to do it. As one of my good friends says, John Ehlers, if you torture the data enough, it will tell you anything. All right, so I choose simple over complex. And that's it. And this is me up here. You can write to me at kaufmansignals@gmail, and I will answer the questions. I said, make it simple. The shorter the questions, the faster I'll answer them. And these are some books that I've written for you people doing the CMT. I think Kaufman Constructs Trading Systems is probably the best one, unless you want the Trading Systems book as a reference, which kind of has everything. But in Kaufman Constructs, I try to isolate which of the things that work best out of the Trading Systems book. So you might find that useful. And that's it. So Sovid, are you still there?
Yes,
Ah, excellent.
amazing presentation. I would say like very short and sweet and very, very crisp. I would say like say these things are very, very simple actually what you said, right? And it's there, everything is there in CMD curriculum, but like following it is very, very difficult, right? So how to follow these things, like if I may ask you?
How to follow these?
Yeah.
Wait, I'm sorry.
So say making a 10-point system is not that difficult, right? But following a 10-point system is very, very difficult, right? Because it has uh, consecutive losing trades, a lot of consecutive losing trades, right? And bigger drawdowns
Oh,
at times.
yes, everything. Yeah, none of this stuff is easy. It sounds easy, but there are a lot of steps in doing this. I don't know if people are able to run their system through a large, run a lot of stocks or a lot of futures markets through their system. I don't know what testing platform they're using. And then I don't know how they would sort them. I do this myself because I program everything myself. And so my system already has this built into it. But it's important. And I think there are um, trading platforms that do allow you to run multiple stocks through a particular system.
Right.
You can then output that to an Excel file, to a CVS file, and then put it into Excel and sort them. It's not brilliant, but it works. It
Right.
all depends on how serious you are about using this technique. I think it's quite important, but everybody has to judge for themselves, and it is work. So, but even developing a good trading system is work. So,
Right. Yeah. So we'll have a lot of questions. We can ask participants because most of them are CMTs or are aspirants to CMT. Uh, and it's one platform which you are getting to ask questions directly to Sir Perry Kaufman. So you can ask your questions by unmuting yourself one by one. You can raise your hand first, and then we will give you an opportunity to speak questions to Perry Kaufman. So.
okay. I said, you want me to answer some of them now?
Yeah, if they have something now.
Okay, as I said, they can easily contact me and I'm happy to answer their questions if it doesn't take pages to explain what they want.
Yeah,
And
definitely.
if and they
They
and
have your
if they
email
don't,
address now. Yeah, Karan, you can ask your question now.
Hello,
You can
Perry
unmute
sir.
yourself.
Yeah,
ah,
am I audible?
Yes.
Yeah, I just wanted to understand how long we can optimize a data. Like, how would we get to know like this is a perfect one, or we no need to torture the data anymore and accept whatever it is?
yes, it's true. I I told you I use a long period of time. Actually, in my futures markets, I actually go back into the 1990s. As I said, there were two choices. You could use 10 years or 5 years, but then your system is going to decay quickly. If you use stocks, you can go back to 2000 if you want a robust parameter. And then when you select which market you want, you still only want to go back 6 months and see how did it perform in the last 6 months, even using the parameters that you used, uh, you know, for the last 20 years or 25 years. So it's it's your choice. There are two ways to do it. You can optimize the short term and have it decay, or optimize over the long term and have something that has larger risk, but is likely to keep performing that way. Did that answer it?
Yeah, I got your answer. Thank you, sir.
Oh, sure.
Yeah.
Yeah, you can ask your question, Anshuman.
Hi, Perry. It was so insightful. Thank you for this presentation, and thank you, Trading Edge too. So I am a data scientist, so I'm totally new to trading. So with my experience, what I have in statistics and implementing models, I wanted to understand like what would be the best way to start building or developing things like uh, in which platform we can implement this trading data easily. So is it Python? Like how do you do it?
Well, everybody has their own program. You're a programmer or a scientist,
Yeah.
whatever works. You just need something that can read the data and sort the results. So believe it or not, I use Fortran because when I started in the 1970s or late 1960s, that's what we used, and that's what we used at NASA. And
Yeah.
there are so many languages that have come out. I decided that they may not, I don't know if those languages are going to be working in the next 10 years. So I just stuck with Fortran. So whatever you're doing shouldn't matter. The language doesn't matter. You just need to develop your strategy and be able to sort the results.
Okay. Okay. Thank you.
I just would like to add on this that say Python is a good option if you are just starting because understand that Python can be linked to most of the trading platforms, right? So
Okay.
you
Yes,
get that advantage.
yes, I actually have had more comments about Python than anything else. So I assume Python seems to be the latest platform. Although I will say it used to be something else 10 years ago. And, you know, I don't know whether there'll be something better in 5 years. Doesn't matter to me. I keep using Fortran.
Mm.
Right, right. Like
Yeah.
I use semi broker and I will continue to use semi broker My purpose is served using it. I think you use TradeStation also, right, Patty?
I use what?
TradeStation.
I do. I switched to TradeStation a couple of years ago. I used to use IB, Interaction Broker, but when something went wrong with my data feed, there was no support. Yes, they didn't offer to correct it or anything, so I just canceled it. TradeStation has actual live people answering my questions. So,
You need support at
okay,
times, yeah.
okay. Ah,
Okay,
we have another
there's a
question.
question. Yeah, there's a question. When is the next book coming and what all topics are you covering in it?
The next book. Have you seen a picture of me here? I'm getting older. So actually what I've been doing is I've been writing articles for technical analysis. And they come out every couple of months. And, you know, that's as much as I plan to do at the moment. You know, a book comes out every 7 or 8 years. I don't know if I have enough new information for another one of these big books. But who knows? I didn't think I had enough information for the last two, and there they are. So
Right.
I'm sorry I can't answer that.
Okay, so which you write for Stocks and Commodities magazine or
Yes, stocks and commodities.
okay, okay.
So,
So we'll
and
start to
it's
read
had,
that.
yes, it's not a big deal. I think you can get it online, and it seems to, you know, I find it interesting, but I mentioned whenever I find an article of interest in it, I program it. And that was my first comment, was that I find that they're very limited to specific situations. And if I try to expand the trading to more markets and more situations, they don't seem to work well. I like systems that are robust. So I suggest that if you read books or look at the magazine that you program, whatever it is, it'll teach you a lot, you know, that how far these strategies can go.
Okay. Yeah. Vivek wants to ask some question. Vivek, you can go ahead with your question.
Yeah, sorry. Have we lost him?
Vivek Jain. I think we have lost him.
Yeah, sir. Can you
His
hear me?
yes, Vivek. Yeah.
Okay. So, sir, I wanted to ask you one question. Like,
Yes.
what statistic test or filters do you personally trust the most when determining the stationarity and persistence of a mean reversion in a price series?
What statistics? Well, I use annualized volatility on my portfolio performance. I use 20 days for almost everything in the way of statistics because that matches the way options calculate their volatility. I just find 20 days is a good basis. So I use that when I use my volatility parity for determining position sizes as well. But in terms of other statistics that I use, what do I use? Not much. Standard deviations. I really remember my philosophy is to try to keep it as simple as possible. One thing that you might find interesting, if you're using stochastic for part of your strategy, has nothing to do with your question. This is just a general comment. I suggest you look at John Eller's roofing filter. it's a very brilliant uh, approach to smoothing out a momentum indicator without losing or without increasing the lag. All right, I use it. It takes a momentum indicator that tends to look very noisy and makes it smooth. And I found that very useful in some strategies. So I realize that's not what you were asking, but it just popped into my mind.
So, Perry, is the formula of this indicator available somewhere?
I'm sorry?
Is the formula of this indicator available somewhere?
It's you can look at it online. Just type
Okay.
in roofing filter.
Okay.
All right. You'll find it. It's part of one of his books, but I think it's online as well.
Okay, great.
It's a little mathematical thing, maybe 6 lines. Very clever. So
Okay. Any other questions? Any participants has more questions? Any comment on very short-term tradings, Perry? Santosh is asking.
short-term trading is really mean reversion trading. You can't use a trend for short term. It's a problem, especially because the volume has a pattern during the day. So if you're looking for an increase in the trend, you'll find that from midday to the end of trading, the market tends to go up. You know, it has a low point when everybody goes to lunch at the exchange. And so trading volume tends to be in a U shape during the day. So anyway, it has to be mean reversion. It has to be mean reversion in the short term. I really don't do intraday trading now. I did in the 90s when it was much easier. I do short-term trading, which would be like 3 days. And I think if you look in my book, I do cover some areas like that, but I'm not doing it myself. I find it's too much work. I prefer this trend following, entering the market in the morning or on the close is as much as I can deal with right now.
Amit is asking, since 70% of time the markets are mean reverting, what do you suggest for such trading style in terms of volatility and risk?
In terms of what?
Volatility and risk. Volatility and risk.
I know you say that, but for some reason it's my sound is not picking that up. Was that quality?
Oh,
No?
volatility.
Oh, volatility. Let's try this again. So in terms of volatility, I have a number of issues. One was in stocks, I track the volatility of individual stocks, and if they get more than 90%, which is quite high, but something that Tesla has gotten to, I stop trading them. Okay, they're just out. For most stocks, annualized volatility above 50% is probably a good place to exit. For a portfolio, I said 32% is my risk limit for portfolio. But in the case of portfolios, I don't want to get out while I'm making money. So I have a second criteria that says above 32%, but losing money. And I use the opposite to get back in, but I mentioned that before. But those are the only rules I have for volatility, or in terms of risk controls. All right, I don't use volatility as part of a strategy itself.
Okay. Since the question also says that since 70% of the time markets are mean reverting, so what do you suggest in such a trading style?
Um, I don't really do much in the way of mean reverting. I mean, one of the strategies I have is a pullback strategy, which means that the trend is going up, but the market's going down, but it hasn't violated its bottom, and it's starting to look as though it's going to go back in the trend direction. That's as much as I can do about mean reverting. And it hasn't been particularly good in this market where things have continued to go lower. So, but it was a brilliant strategy a year or so ago, and will probably be okay again. So pullback strategies, which were, I think, the essence of mean reversion, are not doing too well at the moment. I don't know if that answers the question.
Yeah, I suppose it answers. Amit, I hope you got your answer. Okay. Vipul is asking, what are the soft skills a trader must develop for successful in trading?
What are the software skills?
Soft skills.
Soft skills? What's a soft skill?
Yeah. Good evening, Patty. This is Vipul. Thank you for the insightful session and time. So basically, many of the technical stuffs people know, but from say mentality or psychology point of view, sometimes we struggle. And trading being a lonely business. So what are the other skills we should have apart from technical market skills to be a successful trader?
Oh, I do understand. That is probably for somebody smarter than me. I would say you need a very understanding wife. You need to, I said that the real skill is in understanding the risk. And in finding a system that matches your personality. I don't trade intraday because it's just too much for me at the moment. I'm just not going to do that. There's an interesting story that I may have mentioned in one of the books, that my wife and I have very different approaches. She's a trader also. She used to be a member of the CME, so she's quite good. We decided at one point that we would invest in, we would sit down and decide what we would put our investments in for the next year, whether we put it in the energy market, in the bond market, in, whatever it is. We wanted a long-term plan so that for our personal investment, we didn't have to be trading in and out, not the same as our trading accounts. And we sat down and we had this long thing and we decided how we would do it. And she implemented it. She put our money into these things. And the next week she came and said, okay, we got a profit, I'm out. It was supposed to last a year, but she's a short-term trader. And so, she put these year positions on and was out in 1 week. And so you need to find a system and an approach that matches your personality. And I think that's really quite important. So she can't be a long-term trader. I can't be a short-term trader. So in that sense, we don't have any conflicts. So I think the biggest quality is being able to deal with risk. It's the most important part of trading, is understanding risk and knowing how much risk you can accept without being scared away, and how much risk is acceptable in your system. So other than that, I'd say it's good to have someone to talk to about these things to get some of the frustration away. But other than that, it can be a lonely business.
Perfect.
I have a question. So,
Yeah.
hi Perry, thanks for your time. A wonderful session.
My pleasure.
You spoke about the characteristics of the market, or which market are we looking for to find the correct market for our trading system. And I think all markets have a certain inherent characteristics. Like commodities are very different from NASDAQ top 100 stocks or something, right? So
Right.
my question is, if we suppose to develop a system which works on certain characteristics, which works on NASDAQ stocks, okay, and how do we track that inherent characteristics have changed and our system is not working anymore, not because of that it will work over a large number, just because the characteristics have changed and we need to modify our system. So what are that key things that you look for to determine if the characteristics of that market has changed or not? So can you hide?
Yes, it's a good question. The markets have all changed. The markets from 1970 are not the markets we have now. So the question is, how do you adapt to them? The first thing is, if I test a market and I run my system, you need to run your system through the markets, because not all the markets conform to your system. You can't expect every market to be profitable on your system. So we're looking for the markets that are going to be best. If you run it through and they do terribly for the whole period, I don't even bother. I just discard them. But there are some markets that do well and don't do well and things like that. And that's why I was saying, run your system and then look at the last, say, 6 months of performance, because you want to be able to accept markets that are doing well on your system now that were not doing well in the past. And I use cocoa as an example. I've been traded cocoa for a long time because it was horrible. And then last year, it was the biggest winner. Now, if you want to get cocoa into your system, you're going to have to look at only the performance of your system over the last 3 or 6 months. Otherwise, it'll be a reject. So you're going to have to decide how far back, first, whether your system can make money in the long term, and then how far back you want to look, so that you're not trading it during the bad periods, but you're finding a new trend so that your system picks it up and you can start trading it even when it hasn't done well for the past few years. So it's a more complicated process. And it involves these two things, a long-term pattern and then intermediate good patterns. And the way I have of sorting and picking the top 10 markets, I find is a way of dealing with markets that change. And I think that's my solution to your question.
So usually what we do is we back test, and we back test for a longer period, right? Like for 10 years, 10 years back test. So you are saying
Okay.
that 10 years back test is not worth because the market keeps on changing, and it might not be profitable. So what matters is the last 6 months performance. And if at all, if suppose we have created a system and we have seen that last 6 months have been profitable, or it has given good returns, or the return profile is decent enough, that means it's still applicable, and the markets are in condition to trade, right? Otherwise, beyond 6 months, are you advising that no, it's not uh, very fruitful to look beyond 6 months of backtesting?
No, I didn't say that.
Uh-huh.
And I don't think 10 years is really enough. I told you if first you qualify the markets by doing a longer back test. And I mentioned it, if you do 5 or 10 years, the system is going to degrade. In other words, at some point you're going to pick the best parameters,
Okay.
but they won't last too long and you're going to have to retest. All right. But the whole point of a longer term test is to qualify the markets, to say, okay, I want this market, I don't want that market. So I can eliminate some markets
Uh-huh.
just on the long-term test. All right. You want to show that in the long term, they are profitable. And then from that, you're now going to pick the last 3 or 6 months to decide whether you're going to trade them. All right. So you have two criteria. One is the longer term. Am I going to qualify this market? And the other is the shorter term. Am I going to trade it? And those are your two criteria.
So the loose character, what you are saying is the loosely the characteristic of a certain market changes, but doesn't changes drastically, right? So stocks want to start behaving like commodities, or commodities want to start behaving like stocks. So we can safely do a longer term back test to rule out if commodities is what we want to trade, or stocks is what we want to trade with this system. And then
Yeah.
once.
Yes, I was just going to say, I do qualify if I've tested a market over 20 years
Mhm.
and I look at the performance and it has very few periods in which it made money,
Okay.
I
Yeah.
eliminate it completely.
Got it.
All
Yeah.
right.
Yes.
But
Thank
if
you.
I have a market that makes money from time to time, then I
Yes.
want to trade it when it's making money.
So we can
And
basically have a switch kind of a stuff where we look back 6 months and we say that is this making money? Switch it on or switch it off. The same system on that
yes,
market.
that's correct. But you have to sort them every day and you have to look at the best stocks that you want to put in your portfolio.
Okay. Yep. Got it. Thank you.
Okay.
Okay. We have a question from Vivek Kumar. He says, I have been doing trend following for around a decade now, but for the purpose of diversifying my portfolio, I am planning to construct one mean reverting strategy as well. However, due to my a decade of trend following habits, it has become second nature. And even despite I construct one, I do not feel much confident in deploying it. I also understand that a good trader must have both of these arsenals for long-term survival in the market. What are your suggestions for me to be able to develop one successfully?
That's a difficult question. Okay, first of all, I don't trade anything with mean reversion. I only trade long-term trends. So I'm not good at giving this advice. If you can't develop a mean reversion system, don't bother. Uh, you know, the trend will work. You just have to accept the risk, and make sure that you've done that. But there are mean reversion systems. You can use pairs trading. You can use the short-term S&P. You can find simpler ways of doing mean reversion if you want to do it. I find that mean reversion, although although traders that seem to like mean reversion say that it complements their system, that it makes money when the trend doesn't make money. I don't find it's true because it doesn't make money when the trend makes money. And so I find that it takes away more than it adds to it. So I'm okay just using the trend with proper risk controls, which I do for both futures and stocks. So I don't know if I'm answering it correctly, but if you're having trouble with mean reversion, so do I.
And so do I. I have still not been able to make a single mean reverting system,
But
and I'm okay
even
with
if you
it.
can, I'm not sure it's a benefit to putting it together in a portfolio. Then you have to check your returns versus your risk. And I just not sure it's so clear. There are obviously people smarter than me that can do it, not me.
Right. I think we three are on the same boat.
Yeah.
Okay. There's a question
we-
from Nitesh.
We
How
do
to
need to we do need to finish this up so that I can
yeah.
get on to my real life here.
Yeah, just I think we have one or two more questions. We'll just end up with that. So we'll not take any new questions. Whatever are there, we'll finish them off and
Yes.
then
They,
call off
they
for the
can
day.
write them directly to me and I'll answer them.
Yeah, yeah. So last two, three questions we have. How to find a good wife like you did? Understanding wife, who believes in trading. Now
I
this question.
have a good solution to that. Always find a wife that's smarter than you. So it makes life so much easier when your wife is smarter than you. You know, it's just my philosophy in life. Don't get somebody you have to spend a lot of time explaining things to. You know, better if she explains them to you. So I'm sorry, you finished the question.
Yeah, it's that much only. Okay, another question. How to develop the mental resilience to take risks? Sometimes we think we can take risk of certain amount, but later halfway in a trade, we start having second thoughts. How do you deal with emotions while a trade is on?
Well, okay, that goes back to the beginning. I said you have to develop an understanding about risk because trading is all about risk. I mean, we all love profits, but if you don't understand risk, you can't trade. And so the whole purpose is to start trading small. Don't I don't believe in paper trading. I don't believe that paper trading teaches you anything about risk because it's not real. You know, okay, I took a loss, big deal. But when it's real money, even if it's a small amount of money, you believe you start to understand how risk affects you. That's why I was explaining that story with our daughter. Two good trades and a bad trade, and she went home sick and she couldn't go back to work. You know, she didn't understand risk. That risk is always nice if you don't have it, but when you do have it, it takes time to understand that risk is part of the problem. And you go through it, you take losses, and then you have profits, and you come back with new highs. Now, when you're on new highs for your equity, all of a sudden the risk doesn't seem so bad. You know, you got through it, you see what it is. The next time it'll be worse, but you have a little more confidence that you're going to come back and have a new equity high. It's a process and it takes time. And I don't know that a year or 2 years is even enough. You know, it's it's taken me a long time. Now I'm pretty good with accepting risk of 20 or 25%. It does happen. No matter how great you think you are, your system will lose 20 or 25%. And so be prepared for that. It's not pleasant, but it's what happens in order to make better returns than the market.
Thanks, Perry. Okay, one last question. How to use artificial intelligence tools like ChatGPT in backtesting or generating ideas and insights?
Yes, artificial intelligence is good. You saw all these stories about the judicial system where the judge has discovered that the examples that the attorneys are giving are not real. You know, they were made up by artificial intelligence. I don't know how stupid you can be to believe the things that are coming out of AI are real. I tried using AI by saying, give me a system that does this or does that, or, what's the best moving average system and things. It's ridiculous. They really don't know. Um, they're just, they're just looking at what people wrote in the past and summarizing it in some way. I think it's brilliant technology, but not for what we're doing. It doesn't have any creative ability, and maybe it will someday, but it's not yet. Um, I would not use AI in any of this. What you need to do is observe the market. Try to find something that means something to you. Draw some conclusions about what the market's doing, whether it always rallies on the close, whether it does something. Find something that you can observe that you can then test. Because if it doesn't work on exactly that, you may find some other clue that helps you improve a trend following system or help you with your risk or something. But it's all about observing. And the only way you can do that is by looking at the market. So anyway, no, I haven't found AI of any use whatsoever.
Okay, and my dear friend Apurva said has one more question. Says getting entries is easy, but optimizing exits becomes a challenge. What tools or indicators work best?
Well, I said optimizing exits. Well, now you're getting very specific, but when I sort, I don't optimize exits, I optimize the trend system. And because I sort and pick the top 10, I mentioned that my exit is really when it falls out of the top 10. It's way before the trend changes. So if I'm using a long-term trend, it may give back 30% of its profits, but using my 10 stock rotating approach, I may be out while it's still making money, just because it's not making as much money as something else. So I don't optimize exits. I don't optimize entries. I just use a trend following system.
Perfect, Patty.
Okay,
There's one more question.
wait a minute.
Okay. What we'll do, we'll not take these questions. Okay. You can ask these questions to Perry at his email address, and Perry will answer them to you.
I will
Right,
answer
Perry?
them. Yes.
Yeah. Okay. Sorry for that. We cannot extend it any further. It's already 8:30. Okay.
I mean,
So
I'm glad they're listening and have questions, but I have work to do.
right, right. Okay, so just thank you note. Thank you to each one of you for joining us tonight on Trading Heads, and an exceptionally heartfelt thank you to our guest speaker, Mr. Perry Kaufman, for his profound insights and generosity in sharing decades of market wisdom. In the world where more is often mistaken for better, tonight we saw the power of less but sharper. So basically, Perry's approach was more focused to 10 stocks or 10 instruments or 10 strategies. We explored how selective strategies, clear frameworks, and a systematic mindset can outperform even the best diversified portfolios. To those who attended live and those who will be watching later, may this session sharper questions, stronger systems, and smarter selection in your trading journey. Until next time, stay curious, stay focused, and keep questioning the myths. Thanks a lot, everybody. Thanks, Perry.
Okay, thank you, so it's been a pleasure.
Thank you.
Thank
It's
you.
been a dream come true, Perry, to host you here. Again, we will like you to come again here sooner than later.
Oh, I would love to do that. So anyway, and I have been to Mumbai, I think
Oh,
twice,
wow, when?
but not for the last 20 years. I'm sure everything has changed.
Right, yeah. Yeah, we'd love to have you one day here again.
Okay, I will remember that.
Yeah,
So, okay, so that I'm
Yeah.
going to leave now.
yeah.